Hey guys, welcome to the channel. How can we tell which way the market is going to go? This is a chart of the SPX I've got on the screen here. And as you can see, this is from the first of the year right here. And we went straight down, straight up, 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 up. And now we're in this big indecision kind of zone. We could break out either way. And guess what? We have earnings starting. They've actually already started. But the big ones are coming out next week. And so the question is, how do we tell which way the market's going to go from here? And luckily for us, we really don't have to know, because if we do it correctly, we can place our trades. We can also do a little hedging, and that's what I want to talk to you about today. I've done several videos on hedging the S&P 500 with specific trades and butterflies and different kind of things. But today I want to talk about hedging tech stocks, because next week we've got Microsoft, we've got Amazon, we've got Apple. All of the big names are coming up, especially all the semiconductors, KLAC, Lam Research, Micron's earnings are a little bit later out, but AMD, etc., all that kind of good fun stuff, right? If you have exposure to those or tech stocks, Google, Amazon, Apple, all that kind of stuff, you're going to want to consider at least trying to hedge it to protect yourself on the downside. And how do you do that? Well, you don't hedge with the S&P 500, because that doesn't really track the NASDAQ. So what you want to track or use to track is the NASDAQ index, or primarily I'd rather use the QQQs. Now, to get a little more specific, we could go down to SMH, which is a semiconductor index, and I've got a list over here. The top holdings in semiconductor index are going to be NVDA, Broadcom, AMD, Micron, Applied Materials, KLAC, stuff like that. So you can get them, a lot more specific. And in fact, if we look, most of these names, I'll just pick on Micron because it was the big winner over the last couple months. But up, 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 and away, and now we pull back. That's like a 50% retracement. So this is the zone that we expected it to pull back into. It is, and probably should go this way. But what if we're wrong and it goes this way and they miss earnings and all that kind of stuff, right? We want to be able to hedge that. So in that case, if I had a big exposure to Micron or to AMD or any of the names that I mentioned there in the semiconductor space, I would use SMH, and I'm going to show you a specific trade in a second. Otherwise, broadly based broad index, I would hedge through QQQ, and the top 10 holdings in QQQ are, let me pull them up here. NVIDIA's in both, actually, but that's more Apple, Microsoft, Amazon, Google, Meta, Tesla, stuff like that, right? So that gives you a much more broad-based index to use to hedge on the downside, right? So how do you do that? Well, let's jump in and see. So if I was going to do something on QQQ, and let's just say, for conversation's sake, we've got all these earnings coming up. Again, AMD and Broadcom, and on and on and on, Apple, Amazon, the list goes on and on and on. Matter of fact, let's just use I don't know, Microsoft. So Microsoft is coming up next week here. The trend is down, doesn't look good. I like Microsoft. I think it probably does fine, but what if it doesn't? So if you wanted to put a bullish trade on Microsoft and then hedge it on the downside, you're kind of covered either way. That's the concept, right? Or you work for Microsoft, or you have some Microsoft stock and you don't want to sell it, but you're a little worried about it, whatever, same conversation with Apple or any of the stocks, Netflix. We saw what happened with Netflix. So what I would do in that case, I would come over to QQQ. And again, for conversation's sake, I'm recording this around July 22nd. So let's go out and give it a little time to work. So let's go, say, 21 August. Now, you probably know these are the weeklies. Obviously, it says it right there. The yellows are weeklies. The white ones right there are the monthlies. So you're going to have more volume in the options. And I'm just talking about hedging it from an options standpoint. I know there's reverse or inverse ETFs that can do this, but there are I'll do a whole nother video on that. So there's a whole lot of issues with doing that. The way the leverage works, and I would rather get a pure play, honestly, with an options. Simple, and I'll show you how. So we go out here to 21 August, and let's just say, so right now, let's just say, well, we don't have to say, we can look. So it's at, the QQQ is at 705 right now. Now, if we go out to August, that's 30 days from now, DTE, days to expiration. We've got about a 43-point expected move. Don't worry too much about that. But we just want to pat ourselves on the downside. If you're a little more advanced, you can go in and look at the deltas and kind of figure out, where you want to place it. But for conversation's sake, and here's another way to do it. For conversation's sake, let's just say we are looking down our options chain here, and and where is the largest volume of options is right there at 680. Pretty interesting. 68,000 contracts there. Now that's open interest. So here there's 20 there, there's 40, there's 7, there's 68. That's the largest. It's 20, 28, 7, etc. And again, I can do a whole nother video on all this, how to kind of interpret that. There's 61, but this is the current price right here, right? 705, 705. All right, so let's go back here to, I want to go back to these 680s. So that gives us, that's about 30 points away. 680 to 700's 20 plus 5, 25 points away. That, I want to kind of get inside of that expected move, and I'll show you what I mean here in a second. So let's go. This is going to be very simple. Let's do a put debit spread. So I'm going to click here. We're going to buy a vertical, which is also called a debit spread. Other names out there as well. And let's just go 680, and I'm going to go to 670. Just make it 10 points wide for simplicity. And let's take a look at it. So here is the trade. That's what the trade looks like. I really like the Analyze tab here on TOS because you can visualize the trade and how it looks. So if you notice, the debit's $1.99. Let's do a round number. Let's just say $2, right? So if you notice, when I hover the mouse over here, if you look over here, you're going to see at 822, which this is 821, but on expiration, 822, the max loss is $2,000 if you were to use 10 contracts. 10 contracts, let me get my drawing tool, 10 contracts times $2 is $2,000 of loss. If you're wrong, and we just keep going up and up and up and up and up. So what do we get for that 2,000? Well, if we go down over here, we make 8,000. See right there? So for every $2, if we go down this far, we make 8,000. So, 4 times our money on the downside. That's pretty good. I honestly try to get at least 3 to 1. 3 to 1, or actually this way, risk one to make 3. So 4 to 1's better, right? Now again, we have to go that far down, and we could structure this any way we want to. We could widen these out. We could bring it in closer. We could even go further out and get maybe 10 to 1 or 50 to 1, depending on how we want to structure it. A lot of cool things, creative ways we can do this. I'm just showing you basic stuff. And then of course we come over here to our chart. I just want to see. So on the chart, let me go back here. So what I'm looking at, where do I have to go to get that max profit is right there. And that's at 670 on QQQ. So what does that look like on a chart? 670 is, let's see if I can get it in here, right there. So there's 670, right? So, we take out these lows and we come down there. That's very, very realistic if we were to go down, because remember, back here, remember our expected move right here was 43 points. Well, we're only going down 25 points. So the market is saying you could go down 43 points. That's way further down here. So I think a trade like that's very reasonable. Now, obviously when you see this video, maybe time has passed, or you want to use different strikes or whatever. I'm not saying this is the exact trade. If you see this in the next couple of days, yeah, consider it. But the point is that we can move these strikes wider here, or again, bring it up closer. If you bring it up closer, it's going to get more expensive. Your risk reward goes down, right? And again, there's lots of cool things we can do. We can do butterflies and even get more risk reward and all that kind of stuff. But the point is, we want to hedge something on the downside. So what if this does keep, what if this keeps going down and this turns into a big channel that comes down here, and this goes down and we come down here? There's a 200-day moving average of 642, right? And this, again, I know I'm jumping around, but I've covered a lot of detail of good information here. So that's 30 days out. Do we think it can get there in 30 days? Yeah. If we come in next week and Apple misses and Amazon misses and Microsoft misses and all these companies start missing, yeah, we'll get there very, very quickly. But again, keep in mind your risk reward up here, because nothing is free in life or in trading. Because again, if Amazon, Apple, Google, everybody comes out and crushes it and it goes higher, we spent $2,000 for nothing. Again, it's like buying insurance for your house. You don't want your house to burn down just so you can collect some money, right? Same way here. If you've got a $100,000 portfolio, let's just say, I don't know, round numbers, $100,000 portfolio, and you want to protect 10% of the downside, then maybe this is going to be more, but let's just say we do 20 contracts. Now you got $16,000. I'll try to get a little more. I'll try to dial it in a little bit more. 11, 10. Okay, so we do 13 contracts, and now we've covered $10,000 of downside if we have a $100,000 portfolio that is all tech or very heavy in tech. So I'm just ballparking here, Again, there's a lot of different ways we can do it. Also, if we wanted to get really deeper into it, certainly we could go way out here and we could buy some leaps, and we can go out much further in time. I'm talking about short term because of upcoming earnings, right? And you can do the same theory, same strategy every earnings season, right? Lastly here, SMH, again, if we have a bunch of Micron and AMD, we're full of semiconductors. We love semiconductors. We've got a bunch of them, but we're worried, is this going to trend down here? When we do this, you can do the exact same thing with the SMH. Now the SMH is simply an ETF, right here. So all we have to do, again, same thing. We can choose whatever date we want to go. If we're worried out to October, the market always crashes in October. Well, there you go. There's October. But again, for our sake, let's go to August, 30 days out. That gives us, it's either going to work or it's not in the next 30 days. For example, again, if we're talking about earnings. And you can see there's a lot of volume over here in open interest. 10,000 contracts, 16, 10, 35, 45, a lot of people are buying protection down there. You can do the same thing. Let's just, here again, really simple. I'm going to go to 30 delta, and I'm just going to say we're going to buy a simple vertical or debit spread, and we're going to go, I'm going to drop this down to 35. Okay, so now we spent $3,500 to make $8,900, a little more expensive. We can drop that down 10 points wide. It gets a little bit cheaper. Well, it's actually not moving much. Okay, there we go. So it's same thing, 2,000 there to make 5,000, etc. Again, we can move this up and down. I'm just trying to show you how it works in a very quick video here. So that is one way to do it. In the short term, again, there's a whole nother conversation. Maybe I'll do another video. Let me know if you want me to do another video. I can do long-term stuff involving leaps and how we pay for that along the way and all that kind of stuff. That's a very interesting concept as well. But in the short term, if you want to pad yourself against a specific stock, you can do the individual options for that stock, or you can do broad-based if you've got a bunch of them and use SMH or QQQ to kind of basically hedge the overall NASDAQ, right? It's best way to do it, I think. And the Qs are very liquid and all that kind of stuff. So anyway, wanted to throw that concept out there. It's very relevant, very timely right now with earnings season. So keep that in mind. Let me know if I can help. Let me know other topics or issues you want me to talk about. I'm more than happy to do a video about it. And let me know if you're in my trading room, the Options Income Mastery. Of course, we talk in there every day. Let me know if you have questions at Simpler Trading. And with that, let me wind it up. Thanks for your time, guys. I appreciate it, and I will see you at the next video. Thanks. Take care.